Welcome to the Deep Dive. Today we're jumping into something you asked about, the relationship between the US dollar and the Japanese yen.
Yeah, two huge global currencies.
Exactly. We've looked at some material explaining, what makes their exchange rate tick.
And our mission really is to pull out the key ideas. How do different economic events shift the strength of the dollar versus the yen?
And what are the consequences? For the US, for Japan,
Right,
for you, potentially.
right. It's pretty fascinating how linked they are. So where should we start? Maybe U.S. interest rates.
Good place as any. Okay, so the US Fed raises interest rates. What happens next? How does that hit the dollar and yen?
Well, when U.S. rates go up, think government bonds paying more interest, it basically makes holding U.S. assets more appealing for global investors.
Okay, so money flows in.
Precisely.
Okay.
But to buy those U.S. bonds or whatever, they need U.S. dollars first.
So demand for dollars goes up?
Exactly. Dollar gets stronger. And the sort of flip side of that coin,
The yen weakens?
generally, yes. The yen tends to weaken relative to that stronger dollar.
And what does a weaker yen actually mean for Japan? Is it good? Bad?
It's kind of a mixed bag, really. For the big Japanese exporters, Toyota, Sony, companies like that, it's often good news.
Because their products suddenly seem cheaper to people buying in dollars or euros.
You got it. Cheaper overseas, so they might sell more. Boosts their profits.
But there's a downside.
Definitely. For regular consumers in Japan, it means imports cost more. Think oil, food, energy, stuff Japan relies on importing. That gets pricier.
Right, hits the wallet.
Yeah.
Okay, now let's flip it. What if the US wants a weaker dollar? Why would they? And how does that affect Japan?
Well, sometimes the U.S. government might think a weaker dollar helps American companies sell their stuff abroad. Makes U.S. exports cheaper.
Okay, so it's about boosting US exports.
Often, yeah. And if the dollar weakens, well, the yen tends to strengthen in response.
So the impact on Japan reverses completely.
Pretty much, a stronger yen makes Japanese products look more expensive to foreigners. That can hurt those export giants we mentioned.
Bad for Toyota again.
Could be. But for Japanese consumers, that stronger yen makes imports cheaper. So buying foreign goods becomes easier.
But I guess there's a risk there, too.
Oh, absolutely. If the yen gets too strong, it can really put the brakes on Japan's economy, especially since exports are such a big part of it. It's a real balancing act.
Makes sense. Okay, shifting gears a bit. Global fear. Crises. The sources mention risk-off. What's that about?
Risk-off is basically investor behavior when things feel scary globally, like a big financial crash or geopolitical tensions, a war.
People get nervous.
Yeah, they pull money out of things they see as risky, like stocks maybe, and look for safety.
And where do they put it? Gold.
Gold is a classic one.
Yeah.
But historically, the Japanese yen has also been seen as a safe haven currency.
Interesting. So in a major crisis, you could actually see the yen getting stronger because people are scared.
Exactly right. Think back to the 2008 global financial crisis. That was a prime example. Money rushed out of risky assets
And
into perceived safety. We saw both gold and the yen strengthen quite significantly around that time. It's that flight to safety kicking in.
Okay, clear picture. Now, what about Japan's own central bank, the Bank of Japan or BOJ? What if they raise interest rates?
That's another layer. If the BOJ decides to hike rates, especially if the yen is already pretty strong, it can push the yen's value even higher.
Which, as we said, can be tough for exporters.
Very tough. Makes their products potentially too expensive on the global market. Slows down that export engine.
Or what about inside Japan? Does it cause problems domestically too?
It can, yeah. Higher interest rates mean borrowing becomes more expensive. For businesses needing loans to expand, for individuals wanting mortgages or car loans.
So it can dampen spending and investment.
Exactly. It can lead to an economic slowdown. And given that Japan's economy has had, let's say, periods of fragility, the BOJ tends to be super cautious about raising rates.
Yeah, sounds like a really tricky decision for them. Okay, one last big piece. Japan and U.S. bonds. I understand Japan holds a lot of U.S. debt.
A huge amount. They're one of the biggest foreign holders of U.S. government bonds.
So what happens if, hypothetically, Japan decided to sell a large amount of those bonds.
Ah, well, that could cause some serious waves. If a massive seller like Japan suddenly dumps a lot of U.S. bonds onto the market,
Supply goes way up, so the price.
price goes down, and importantly, when bond prices fall, their yields or interest rates go up.
So Japan selling U.S. bonds could actually push U.S. interest rates higher.
Yes, not just the rates on those specific bonds, but it could have a ripple effect across the U.S. economy, meaning potentially higher mortgage rates for home buyers, more expensive loans for businesses, even higher rates on car loans. It touches many parts of the economy.
Wow. And does that stop at the U.S. border?
Probably not. A big move like that, causing turbulence in the huge U.S. bond market, could easily spook global stock markets, too. It really shows how interconnected things are and the kind of influence Japan holds.
So wrapping this up, it's clear the dollar-yen relationship isn't simple. It's driven by U.S. interest rates, Japanese rates, deliberate currency policy, global investor mood swings, even Japan's massive bond holdings.
Yeah, a whole web of factors. And they all have real-world impacts on companies, on jobs, on the price of goods, both in the U.S. and Japan and even beyond.
It really makes you think. Considering how interconnected everything is, what kind of unexpected global event, something we haven't even discussed, might be the next big thing to shake up this dollar-yen dynamic?
That's the key question, isn't it? And maybe more importantly for you listening, how could businesses or even individuals start thinking about preparing for those kinds of shifts? Something to mull over.